This is a company called UPL, backed by Vanguard, projects a financial or foreign institutional investor, which projects a strong revenue growth in FY26, which can be a part of your watch list. It's a chemical company with has drawn investor attention after the growth strategy for FY26 aims to boost both revenue and the EBITDA margin. The company is banking on improved capacity utilization, product diversification, 4 to 8% revenue growth in FY26. Company expects EBITDA growth to 10 to 14%. Company aims to enhance cash efficiency by negotiating better credit terms and optimizing billing cycles. Additionally, the strategy includes aligning sales closer to peak seasons in key markets such as Brazil to improve cash conversion. The company is prioritizing profitability over sheer volume growth by optimizing its product mix and emphasizing high-margin products like new product launches, SKU rationalization. Innovation remains a key pillar with the focus on expediting product registration, especially for new active ingredients. The company is targeting a strong innovation rate and projecting 130 million US dollars in new product launches in FY26, reinforcing driving future growth through scientific advancements. UPL aims to accelerate growth in natural plant protection segment, targeting a 13% CAGR from FY25 to FY30. Geographically, company is expanding rapidly with new launches in Brazil, North America, and key regions. Aims to surpass 700 million in net PP sales, that is excluding India, by FY27, supported by 10 new technological currently developments in developed countries, or in development, sorry. Advanta Seeds is a global seed company under UPL Group has announced a strategic acquisition of key assets of K. Adriatica. The deal includes temperate corn breeding, germplasm, a strong pipeline of hybrid and diversified corn portfolio. The acquisition boosts Advanta's position in Europe corn market by expanding its crop portfolio, enhancing its value proposition to farmers. The acquired germplasm is well suited to European climatic conditions, making it strategic for fit for the region. Important disclaimer information. The article is extracted from different resources on the internet. All investment opinions and recommendations mentioned are of the broking houses, rating agencies, and experts. There is no personal opinion or advice here. Stock market investments carry inherent risk of financial loss. Investors must exercise their own judgment and conduct proper due diligence. The author bears no responsibility for any losses resulting from decisions based on this article. It is strongly recommended to consult a qualified financial advisor before making any investment decisions. I will go through some important information. So this is the logo. Good evening. Yes, friends, this is the logo of the company. You can see it's about their boy Sir Palgar uh, outlet. And this is some write up on the company. Price of 632. 25% return in the last 6 months, about 16.5% return in the last 1 year. Principally engaged in business of agrochemicals, industrial chemicals, chemical intermediates, specialty chemicals in production and sale of field crops and vegetable seeds. 51,000 market cap, high of 699, low of 484, price to earnings ratio of 48, which is pretty high. Book value is 346, so company is trading less than 1.8 times its book value, which is good. Dividend yield is 0.16%, return on equity is 4%, return on capital employed is 7.7%, face value is 2 rupees. Company's working capital days have reduced by 15 days, which is a very good sign. Company is maintaining a healthy dividend payout of 22%, which is again a very good sign. Company has a low interest coverage ratio, which is negative for the company. Poor sales growth of 5.46 CAGR over the last 5 years. Company has low return on equity of 4.6% in the last 3 years. Sales, you can see uh, in the last quarter the sales revenue has grown by about 35%, which is a good sign. Net profit has grown by about 25%. Sorry, not 25%, 22%. Then you can see quarter on quarter there is about 7-8% revenue increase. In the last 1 year, 8% revenue increase. 7.5-8% year. So from a negative of 1,800 crores last year, the companies managed to turn profitable again and an 820 crore profit. However, in the last 2 years ago, company made a net profit of 4,400 crores. So there's a lot of fluctuation, which is the reason why there is correction in the stock price over the last 1 year, especially after the negative returns that the company uh, declared at the end of the year. Profit growth of 198% here from a negative to a positive, then sales growth of 8%, uh, stock price growth of 16%, and return on equity of 4%. Reserves grown by about 4,300 crores, which is a positive sign. Borrowings have reduced, which will improve the overall profitability of the company, which directly leads to reduced interest costs and improvement in their financials. Liabilities have slightly increased, which is something that the company has to keep a track of. Debtor days have reduced, inventory days have reduced, days payable have also reduced, cash conversion cycle has gone up, working capitals have drastically reduced, which is a good sign. The return on capital employed has dropped from 14% to 8% in the last 2 years. Promoter holding of 33.5%, foreign institutional investors holding 34%, direct institutional investors 18.5%, and public holding is about 13.7%, which has reduced by almost 2% in the last 6 months. So as long as the public holding remains around 10%, there is chances that the stock will have a stable price and stable volume range in terms of shares traded on the exchanges. So it will be overall a good uh, improvement for the company. Thanks for watching, friends. We'll connect with another video tomorrow. Please share this with your friends, family, and associates so that they could benefit from this information as well. Thank you. Have a lovely night and connect with you over the weekend. Thank you.